Welcome to our session on revealing the secrets of price action trading and what I like to often call tape reading. This is an introductory session as there's so much to learn in knowing how to read price action. But first of all, we have to understand that trading certainly has its risks, and all information in this video is provided for educational purposes only and is not an offer or a recommendation to trade futures, stocks, options, or Forex. We'll begin with what we call the isolated pivot high and lows. We have two types, basically fully formed pivots and also partial or incomplete pivots. Let's take a look at the fully formed pivots. You can see that on the set of pivots on the left-hand side here, the center candle, price candle right here, has a high that's higher than this high and higher than this high, and also a low that's higher than the low of both the preceding candle and also the following candle. The isolated low has a low that's lower than the preceding candle's low and also the following candle's low. And this middle candle has the high is lower than the high of the following candle and also the preceding candle. So this is a chart that you really want to take a look at, study, and commit to memory so you can identify them on your charts. Now that's the fully formed isolated pivots. Let's look at the partially formed. These also have a role to play, as we'll show you shortly on a live chart. And we see here that on the isolated high, we still have the high that's higher than the following and also preceding candle. But you notice how the low on this middle candle has failed to be higher than this low right here. It was higher than this low, but it was not higher than this low right here. So it's not fully formed, but yet still serves some beneficial purposes. Now on the isolated low that's partially formed, you see again the low is lower than both the preceding and following candle, but the high is, while it's lower than the preceding candle's high, it is not lower than the following candle's high. So there's a little bit of difference between the two. It might be just kind of a nuance, but it's worth taking time until you can commit these to memory, both the fully formed and also the partially formed. Now, in addition to the isolated pivots, we have what we call tweezer tops and bottoms. We have good purposes for these. One is to alert to potential reversals. It's not true all the time, but it's at least somewhat of an alert. And also it reveals areas of what we call local supply and demand. The tweezer top, by our definition, is simply showing that these two candles have the precise equal tops. And tweezer, this should say bottom right here, the tweezer bottom would have a precise bottom right here on both candles. The trend dots are actually an EMA using the 9-day period, or rather the 9-period EMA, and we use dots and not lines, and we typically set them to a thickness of 3 ticks. Let's go take a look at a live chart. We've got a chart of the ES, and we're going to set it right here, and this is a live chart. And what you're looking at is a very basic chart. We've put a few things on it to prepare for this presentation, to include 3 moving averages. I've got a 15 moving average, a 30, and also a 60 period moving average. I've also drawn a vertical line when the 15 crossed above the 30 and also the 30 crossed above the 60, because we find that often will indicate a reversal in trend. Again, not always, but it's a good indication. The other thing I've gone ahead and done is put the dots where the isolated highs and lows are, that is to say the fully formed ones, And I've also put little triangles on the chart to show you where the tweezer bottoms and tweezer tops are. For example, here's a tweezer top right up here. These two candles have the precise same value or level on each of those candles right there. Just as this candle right here, where you see where I placed this triangle, they have an equal level on their bottoms right there. Okay, so let's see how we can add those trend dots, because we're missing the trend dots. We'll go into our indicators, and we've got, you notice that we've got an EMA 9 period, which is showing right up here. And I choose to set it to on tick because I do want to see immediate reaction whenever there's a change in ticks or price change. Another option is, if you want to conserve the demand on your computer, is you could do it on price change, but I choose to do on tick. I also eliminate the name so it doesn't clutter up the chart any more than necessary. There's no need to display it in the data box, and I get rid of the price markers on the right-hand axis, because that, again, seems to clutter things up. Now, as far as the EMA, you want to go ahead and choose whatever color preference you want, and then dash style would be solid, plot style would be dot, and I'll make it a size of 3 tick width. So if I click OK, and also make sure I have the visible check, and hit OK, you can see we now have the trend dots on our chart. So let's see how we might use all these. We take a look at our chart and we see that we had a trend towards the downside, and then we saw a reversal. As I said earlier, we like to see the 15 EMA cross above the 30, and then also the 30 cross above the 60. So we have both those in place, and typically we like to see a pullback. We like to see the candles leave the trend dots. Think of the trend dots almost as a railroad track. We want to see the price candle rise above the trend dots and then come back and tap them. So you can see where I've already identified where this price bar came down and tapped this trend dot right there. Now let's go ahead and put a risk reward tool in there. So since you're using NinjaTrader, you can hit Control F4, and I've got it set to a 3-to-1, 3 reward to 1 risk. So if this was our entry right there, let's go ahead and see if we were to use this most recent swing low down there. Let's see how that might work. By the way, you see that there is a risk of $187, and our assumptions are that we're using a $10,000 trading account, and we're willing to risk 2% of each trade. So 2% of 10,000 would be $200, so we're within our parameters as far as risk is concerned. What we like to see is a 3 reward to that 1 risk, so the reward would be $562. So let's take a look at how this price action might have unfolded. We can see that once we entered, there was a continual pullback, and it actually came down and tapped our 60 EMA right here. So we're well above our risk level down here. An alternative risk level could have been, if you have a smaller account, perhaps use this recent low right here. It wasn't a major low, but it would be one that you could use, and that would be a risk of $75. Now here's a little trick. If you want to understand how much you need in the sense of account size with your risk, and you're willing to, for example, use a 2% risk, put $75 in your calculator and divide it by 0.02, which is your risk. And it tells us we need $3,750 account in order to accommodate that risk of $75. But in our case, we've got a $10,000 account, so we can, if we choose, use this as a area of risk down here. All right, now let's move on and see what happens here. We're nicely cleared from this risk down here. Price continues on. You notice that we've got some isolated low dots down here, And I've drawn manually, I put this line at the very tip of this candle, this isolated low. It's a fully formed isolated low. Why? Because the low is lower than the following candle's low and the preceding candle's low, and also the high of this isolated low candle is less than the following candle and the preceding candle. So that forms our isolated low, and we see that we did have an isolated high way back here. It's hard to see, but the pin high is right there, so I drew this manual line across there. But we have prices moving up conveniently in our direction, and we have, let's see, moving along here, we see we're in a bit of congestion. This is early in the morning, about 7:15 or so, and not to be surprised by congestion during this period of time, but we're hoping to squeak out some profits early in the day. As a matter of fact, we have, let's go ahead and draw what we're seeing here in the way of a bit of congestion area in there, like so. And what we see later on the morning, about 7:45, we see one candle that is a little more prominent than the others. As a matter of fact, it looks like, you can see I put a marker here just so I could easily get it for this presentation. We see we've got a good amount of volume. Now, it may not look like a lot of volume, but remember, we trade the hard right edge of the chart, don't we? So let's go over to over here to the hard right edge, right there. Okay, now there's that, I'll call it a thrust bar right here, and you can see that the volume is really the highest amount of volume we've had until, well, the last 2 or 3 hours. So that would be an indication to me that buyers are interested in moving this price further up. So with that in mind, I'm not going to get in it on that thrust bar. What I want to see is I want to see a pullback, and ideally at least to the 9-period trend dots as an entry. So let's go ahead and put another risk reward tool right there. That would be right there. It's already marked, right? And we could use this recent swing low right there as our risk. And you can see that, well, we didn't, of course, know this until later on, but we weren't stopped out of that, were we? So we can see that we have another entry, price pulls up, price pulls back. Now, how can we use these isolated highs and lows to determine whether we should stay in this trade or not? Because after all, we've got a pullback here that's pretty substantial. Well, as a matter of fact, before I forget it, let's go ahead and identify what might be a bullish flag. All right, we'll just put that there so we don't forget it. And again, we don't know that until it forms, but I just didn't want to forget this to play on that later on this video. So what we do see is prices come up, giving us some profit, and I would say that's probably close to $165 profit at that point. And don't forget, we're already in one trade over here, right? And as price comes down, we want to take a look at our isolated highs and lows. And we have, let's see, we have an isolated, I'm going to go ahead and draw, better yet, I'll take one of these, I'll copy it, and I'll paste that on so. And we've got an isolated high there. We have one up there. But what we're doing is we're watching the price candle and its relationship to the trend dots. Now this black candle right here close below the trend dots, and the trend dots are sloping downward. So that would put us in what's called congestion. So what we look for at this point is we already have this upper trend dot, which defines the upper edge of our congestion channel. So now we're looking for another isolated low or a partial isolated low, which will then form our new lower boundary on our congestion channel. So I'm not seeing any fully formed isolated lows here, and I'm looking for if there's any partially formed. I don't see one yet. That bottom one, that's the same. Don't see one there. The first one I get really is right here. See how that low is lower than this candle's low and lower than this candle's low. Now it's not a fully formed isolated pivot low because the highs of those three candles are not in the right configuration. So what I would do is I would extend the pin bottom right here off to the side, and now we've got what would be considered a congestion channel. And here's what I would do. This might make it easier for you. We have that isolated high. We have this isolated low, albeit a partial formed one. So I'm now looking for a close below this upper level or this lower level. And it's a close, not just simply piercing it and coming back in. So we had no threat down here, and by the way, there was our stop for the second entry back here. So what we have is a breakout of this bullish flag right here, albeit a short candle, it's black, but it proceeds on up. We have a very strong bullish candle right here, and we see that with this, the other thing that's important to keep in mind is if we have a developing isolated high or low that's lower than this high or higher than this low right here, we then make that our congestion channel upper and lower boundaries. We never expand the congestion channel, but we always compress it, and then we wait for price to break above that more compressed congestion area as a confirmation of a continuation of the trade. Or if you're not in a trade yet, you could use that as an entry point as long as your other parameters were in line for your own rules. So what do we have? We have a breakout right here, which has now eliminated the concern that we had back in here. So we continue to be in this trade, and we're still in this trade as well. Of course, you could have chosen to get out of this trade when you were up at this point right here. So that's an individual call. Well, what happens from that point forward? Let's walk it through and see how we would handle it. Price continues to come up, and you can see some where I've drawn the little triangles for our tweezer bottom. There's another tweezer bottom right there. And price comes back and gives us some concern again, pulls back, and there's our fully formed isolated high right there, and pulls back, falls below the trend dots, and notice the trend dot is lower here than it is here, and the candle closes below that trend dot, so we're back into congestion again. So what do? We identify this most recent isolated high. I draw that little line just for visual reference. And then we wait for either an isolated fully formed low or a partial isolated low. So this comes down here, and this serves as a partially formed isolated low. Again, the low is lower than this candle and that candle. It's just that its high doesn't fully conform to the fully formed isolated high. So price comes up, comes back down, threatens our isolated low right here. But remember, I said it's got to close below it for us to take any action if we're going to exit the trade. And remember, our stop is way down here, right? So we've got profit in hand. But right here, it came down. Remember I said that isolated lows and highs showed local support and resistance, or local supply and demand. So you can see how that's actually bearing out right here, where price came down, couldn't close any lower than right here. So we're still in that trade. We're still in the trade. Price breaks above it, and now we're at 8:30 in the morning. There could have been some news. I'm not sure. This was yesterday, which was November 2nd, 2023. We have a very strong candle here, high volume right here. So anytime you see a candle that breaks above a recent swing high with strong volume, you know that there's very serious interest in moving price to higher. So let's see what continues on here. Does it threaten our trend dots at all? A little bit right here, but notice trend dots are even, and it closed, I would say, on the trend dot. I don't think it closed below it. So we're still in it. There's nothing to scare us away. And it's coming up, coming up, coming up. Now it's getting about 9 o'clock in the morning, and you've got quite a bit of profit. So what do we have up here? We have a tweezer top right there. Now remember, you don't execute just on tweezer tops and bottoms, but it's just catching your attention, and that's also an engulfing candle. It's an engulfing tweezer top candle. So there's a lot of messages in that little formation right there. So what we might want to ask ourselves is, do we want to remain in this wonderful trade with the New York Open looming within the next half hour? So price comes down. It closes below our trend dots right here, and we're saying to ourselves, you know what? It's shortly after 9 o'clock. We've got a tweezer top, an engulfing candle. We've got plenty of money in the bank, so let's close it. So that's one way you could handle this trade, where you win those two trades. Now, let's just take a look at what we might have had in terms of profitability. Take our ruler. This is where we got in our first trade. And remember, that was our risk down there, right? $175 risk. A lot of consolidation in here, a lot of chop. But we knew we had our stop here to keep us, at least to manage our risk, which is rule number one. And so this would have come all the way up. And let's say that we got, there's the close above the trend dots. We've got the the engulfing candle and the tweezer top. This closes below it. We've got a lower trend dot than here. So we elect to get out right here, which would be the opening of this up candle right there. So that gives us $875. We were also in the second trade, and with not a whole lot of risk on a $10,000 account, $112 risk, but we rode this up with the same reaction to our trend dots and reading the tape. And if we get out at the same time, could leave it as a runner if you want, but let's just say we have a golf outing later in the day we want to get to, and know that we've got, what's that, $1,600 in the bank on one trade. So you can see how a lot of the uncertainty that we traders might face when we're in a trade could be clarified. Now there's some choices that you could make in here. You could have gotten out, well, let's see, the first goal or first target for our first trade was right at this level. So right about here, you could have chosen to get out of the trade right here along with that second trade. But by reading the trend dots, by reading our isolated highs and our isolated lows, with a little help from our tweezer tops and bottoms, we were able to remain dedicated to this trade to the point of really wringing out a lot of the profit that it handed to us. So I hope that gives you a good sense of how to go ahead and read charts. I do want to emphasize what I call rule number 1, or FAR. First, assess risk. And you saw how we did that as we reviewed that chart, looking at our risk as a percentage of our account and trying to decide, where to get out. Now, keep in mind that we could have used the isolated highs and lows had we had a situation where price closed, say, below an isolated low. We could have gotten out there and not take all the loss that you'd have by letting price go all the way back to your risk level. So it's also a way that you can minimize losses on those trades that you do exit. So stay tuned for future educational sessions revealing more secrets of price action and tape reading. And thanks for watching, and sign up below for Ninjacators' free Indicator of the Month Club and enjoy hundreds of dollars in savings.